Good morning. We're coming to you from the Spotlight Studios in Morristown, New Jersey. This is the Morning Spotlight podcast. I'm your host, Mike Ham. It's Tuesday, so we're talking real estate. We got a great panel, all of who were former Morning Spotlight video guests. This is the first time ever we've had 3 Morning Spotlight guests on a panel. So let's meet them. We're talking real estate finance today. Our first panelist has over 10 years of experience in the real estate industry and has held a variety of roles, including working with established and startup private equity firms, real estate tech companies, investment brokerage, and other industry-related firms. He's a director of business development in the real estate services group at EisnerAmper. Darren Griffith. Darren, how you doing today?
Great, Mike. Thanks again for having me and having everybody on here. Appreciate
it. Absolutely. Thanks for coming on. Our second panelist regularly acts as counsel to national, regional, and community banks in commercial lending and asset-based finance matters with experience in middle market lending transactions and syndicated credit facilities. He's a partner at Murphy, Schiller, and Wilkes in Newark, New Jersey. Charlie Wilkes. Charlie, welcome.
Mike, thanks for having me today. It's great to be here with you, Darren and Jessica. I'm really happy to do this.
Happy to have you on, man. And last but not least, our final panelist has been in banking since 2011, specifically in commercial real estate lending for the last 5 years. She's the vice president of commercial real estate at Foundry Bank, Jessica Veliz. Jess, how's it going?
Good, Mike. Nice to be here. Nice to see Darren and Charlie. So looking forward to this.
Me too. So let's just jump right into it. Darren, we're going to start to you. How do you see COVID affecting different ownership classes here in New Jersey?
Well, I think they're all, affected a little bit differently, right? So when you think about, your stalwarts, what we'll call in New Jersey, industrial and multifamily, I think those two are probably holding together a little bit stronger than the other asset types right now. You're finding that, at least from what I've been seeing, industrial's getting stronger. I speak with brokers all of the time, and I actually spoke with an ownership group earlier this week, and they said they just signed 3 big leases in the industrial spaces that they have. So the leasing activity is still very strong, and obviously the lease is the financial tool to the investment. So obviously the investment is staying strong there too. Multifamily, people need places to live. I think the strengths in multifamily are the A and B class asset types or asset classes. Those are going to remain strong. You have New York. You have New York right around the corner. We're going to always be a stalwart for employment. We're always going to have a highly educated population that's going to be able to, afford to live in higher priced apartments. As simple as that. Retail, that's my bread and butter, my baby, and I always hate to talk about it, but retail was struggling before COVID, right? So COVID has kind of been that accelerant on the fire, and has kind of accelerated retail, and you can talk about restaurants, you can talk about movie theaters, you can talk about, your Neiman Marcuses, you can talk about whatever you want to talk about it. And most of it on the retail end is not looking great, right? So there's that. Now the most interesting one, of course, to me is office space, right? So office is interesting because you have all the folks, moving out of the city. You have maybe some companies who are seeing that, our employees are working great from home. And maybe we don't want to have as much square footage, or maybe we don't want to have as much square footage in the city, but maybe we want to move some to the suburbs in order to accommodate our employees that are going to be there, right? So I don't see that as a quick transition because, again, office leases are a little bit longer term leases, but I think you might have some short-term temporary space that might be taken in New Jersey or Connecticut or wherever it might be in the suburbs for the short term, so that people can have a place to go, that they don't have to commute into the city, because that's a whole nother aspect of the office space is how do you get to the office, right? So you have a subway, right? So for myself, for example, when I have to go into Manhattan, it's Penn Station, Times Square, Grand Central Station, right? So I really want to go through the 3 most traffic places in all of the city in order to get into work. So obviously, no, that's not the case. So I think there's that whole part. And then there's the whole part of those people who aren't taking the subway, right? Those people are driving in, and Manhattan's just not prepared parking-wise to take on all of that excess car traffic that's there. So so office is the most interesting one. But I don't think that's going to change much. In my opinion, my personal opinion, I think it's going to be, it's not going to be a massive fluctuation like maybe some of the other asset types. And so I don't know anybody else's thoughts on that.
Yeah, I don't think office is going to go away, really.
Mhm.
I agree with you, Darren. Companies are still going to want to have their teams and people come in. I'm seeing a lot of the whole A and B structure breakdown. Companies that are in the city are actually looking for space in New Jersey, Connecticut, Long Island to put their teams in, sort of to work close to home versus working from home. I do think that we'll probably see some sort of market correction. Maybe rates will come down a little bit on the office side, but I don't think it's nearly as bad as what we are probably going to see in retail.
Right.
Just for the office correction. So do you think that rates are going to drop from what you've been seeing from some of your clients on the lending end? You think some of the rates are going to drop on the office space, both city-wise as well as suburban, or do you think it's going to drop for both city and suburban?
So it's interesting because a lot of markets in New Jersey have kind of stayed in that 20% vacancy range. And I think that maybe there'll be more demand here, so our prices may hold up. But we'll definitely see some correction in the city. So many companies haven't even gone back. They don't know what to do with elevators. It's a huge problem.
Yeah.
That's funny that you say that. We have a partner here at EisnerAmper. I was on a networking group with her the other day. She lives in Livingston, and she's like, normally it takes me 2 hours to get into the city. And I went in the other day to clean out my office, and she said it took 35 minutes to get into the city from Livingston, right? And then she said it took another 2 hours to get up the elevator.
Right.
So there's there's that whole
trade-off.
Yeah. There's that whole part of it. It's the same commute. It's just a matter of kind of shifting it from outside of the building to inside of the building. But I agree with you, Jess.
So I was reading an article that I sent over to you guys on Globe Street talking about the residential market bouncing back, and our first episode was strictly focused on the residential market and how crazy that market is right now. With super low supply, like ridiculously high demand, incredibly high absorption rates. But they noticed that the commercial market wasn't bouncing back as much. It was kind of remaining stagnant. And a couple of those classes between multifamily and obviously retail were the ones that were kind of like forcing that to lag behind. Obviously, the industrial market is staying strong. It's, increasing right now. Any thoughts on that from you guys?
I think the industrial market's going to continue to remain strong, and in fact, it's probably going to surge to the extent that it can.
Right.
If anything, there is a lack of supply of new buildings that that can be constructed and absorbed. So we're probably really at 100% occupancy, not at 90% or whatever number is floated around, because the simple reality is that if you're at 90, 95, you're really at 100, right? And that there is room to build in the marketplace to build and absorb new buildings. In my practice, we deal with a lot of industrial, and we're seeing activity across all spectrums of industrial. Darren and Jessica mentioned sort of A and B type properties before. I mean, we see, activity across A, B, C, and D,
yes.
Right? Like, or maybe even F, right? Like if it's a building, it's in New Jersey and it's somewhere near a highway or roadway of some connectivity, you're seeing interest in the property. In fact, we have clients who tell us, like, please find us any building. Let us know if you can find any building, even if it's, the biggest piece of crap out there with environmental problems and so forth. And look, I think in this respect, COVID-19 is really just accelerating trends that existed prior to COVID-19, right?
Yeah.
If you were a non-Amazon person or non-Peapod person before this thing, now you're definitely, using Amazon or Peapod. And if you were using them before, you're using them more now, right? So it's not, I don't think it's the death of retail. People will still want to go out and have an experience, but, you're seeing an acceleration, and, in order to support that acceleration, you need more industrial real estate.
But what do you think is going to happen? Like, for instance, these malls, for a few years, we saw a lot of the bigger box anchor stores go away, close down shops, and the malls were shifting to bringing in gyms. You know, we see Planet Fitness at a few malls, and becoming entertainment centers like, oh God, the American Dream Mall, is that what it's called?
Yes.
What a dream that has been.
Which by the way, literally closed down like 3 months after it opened, after 20 years of trying to get it open. I think
it's their fault we have COVID.
right.
That was the breaking point for sure.
Yeah, so now they have to move away from that model where they thought they were pivoting into these new avenues to have revenue and occupancy in these big malls. And now we're seeing that we can't have these many people congregated in a closed space, at least not for a few years. I mean, we're probably not going to have a vaccine for a long time. Right. And so what do you think? Do you think some of these spaces become fulfillment centers? We just go to the mall to pick things up and
I think Darren probably have some thoughts on this as well. I mean, I definitely think you could see more, online ordering and pickup at some of these locations. I do think I've sort of been somewhat of an optimist, and usually my partners tell me I'm a pessimist. But I think we're going to go back. We're going to go back to normal more than people are expecting right now. And I just think that's because, like, human nature, right? Like, people want to be entertained. They want to get together with their friends. They want to go, they want to walk the mall, right? Like malls exist because we like the experiential element. I think you're right. I think it's going to take a couple years before we actually return to the levels we were at. But I do think the experiential retail, and this is just me kind of, giving my own 2 cents. I do think that will come back. I do think that will come back. The B malls, the J.C. Penney's, the Sears of the world. I think if they weren't dead before, they're probably dead now, and probably those malls have become fulfillment centers, right? Those sort of tertiary or secondary malls, they could be converted, to warehouse, fulfillment center, online ordering and pickup, things like that.
Yeah.
I think the Garden State Plazas and the Short Hills malls of the world will come back and continue.
Yeah.
I really like seeing Targets and some of the supermarkets like Whole Foods at some of these smaller malls.
Yep.
Thought that were really good ideas
too.
Yeah, absolutely. So we're talking real estate finance today. So now that we have a good base of what we think the market looks like from, 3 experts that I hold in very high regard and have a lot of respect
Expert
for.
is a loose term.
You're an expert to me, man. You're an expert to me.
Very.
So let's jump into that kind of stuff now. So Charlie, when we did our spotlight video, one of the things that we talked about was the relationship between mortgage lenders and landlords right now. Take us through some of the stuff that you're seeing in respect to that.
So, I guess what we talked about, most specifically last time we talked was forbearance, was modification and forbearance. And the way I like to describe it as sort of a trickle down or trickle up process. The tenant has to close, can't make its rent payments, calls the landlord and says, I need an abatement or a deferral on rent. And then the landlord calls Jessica or someone else at the bank and says, well, I need some kind of forbearance on my mortgage payment because of these deferrals and abatements that I'm being asked to give my tenants. And I think, in the initial couple months of this, everyone was really committed to working together from, the tenant side through the, up through the mortgage lender side. I think now I'm seeing both, I would say, landlords, and probably rightfully so, landlords and banks start to push back a little bit. They're seeing the economy reopen, and they're sort of, leaning on the tenants, and the banks are leaning on their borrowers saying, look, we understand the numbers might be a little bit tight because you have, your business is down or you have a couple tenants that are paying less, but we need to move back to normal. Right. Like you need to, be making your payments. And I see those conversations as, as friendly and constructive. But I think we're seeing a push to get back to normal. At least that's been my limited experience with my clients. And some people may be having different experiences, but there's definitely a push to get back to normal.
Absolutely. I would agree with that.
Yeah. So Jess, I know we talked about, when you first started, because you've only been at Blue Foundry for a few months now.
That's right.
When you first got there, you were doing a lot of forbearance work. So has that changed now? Or are you still doing a lot of that kind of stuff, or has that kind of slowed down now that we've kind of slowly moving ourselves back to some type of normal, not all the way back, obviously, but.
Yeah, I think things in March and April were very much a knee-jerk reaction on behalf of a lot of the customers for forbearance. It's not as busy as it was, but I think it's something that we're going to live with at least for the rest of this year, in some form or another.
Right.
Yeah.
So then I guess that kind of leads me into my next thought was, the way that the economy is set up right now. I mean, interest rates are still super low. You have the, federal government, state governments injecting a lot of support into the economy for just regular people, for businesses. There's the forbearance stuff. There's a lot of different things going on right now that, they're trying to help us sustain. But what's going to happen when, the music stops? Like, where is this taking us? Are we trending in a positive direction? Are we trending in a not so positive direction? What are you guys seeing with that?
I think right now we don't know, because of all the help and stimulus and forbearance and cooperation between all parties. I don't think we really know the full scope at this time.
Yeah.
And this virus has become very much a national problem. Initially, it was kind of like a coastal issue. And now I'm seeing it everywhere. And while we're opening up, it's still increasing in other places. So I'm not sure what impact that will have as well.
Right.
But I do think that as these programs wear off, particularly at the end of this month, at the end of August, by 9/30 numbers, I think we'll really see what impact it's having on all the banks, and on REITs and investors. On my end, at least, I've seen things really be slow on the lending side, very slow. There's a few transactions we've been working on, and they're moving along, but it's been a very slow process.
Yeah.
Multifamily, I think that the collection numbers are very promising. But then again, we don't know to what extent a lot of these tenants are relying on stimulus, the additional funds in unemployment, savings, and whatnot. So all these things, as the pandemic takes longer, I think that it's going to have more of an effect. And anyone who had a problem before this even happened is really going to have a problem at probably September or October.
Yeah.
No, I completely agree with Jess, in the sense that, nobody necessarily knows, but, once we do rip off that Band-Aid, right, we figure out what's going on. I feel like I've been saying 6 to 12 months for like the last 3 months, but right. I say when we're say 6 to 9 months from now, where all the money's dried up, if we are coming back out with this second check, right, for, income levels under 40,000 or whatever that number happens to be, what is that going to look like? From my perspective on the apartment side, I think, the A, B apartments are going to be relatively fine. I think you when you start getting into those, workforce C class housing where, a lot of our service workers are, and that's a lot of, unfortunately, where the people, who got laid off live. Right. It's going to be, we're going to find out, what those checks look like. Right. And to Jess's point, collections have been relatively good. I've seen numbers like 95, 98% collections in A and B markets. Right. So that's strong. And that, I think personally, that will remain strong. I think on the back end of that, when we, again, going back to the, the C class, I'll call apartments, right. We'll start with that kind of asset class type. I think you're going to see the people who own 50, 100 units. Those are going to be the people that may struggle. The guy who has a full-time job and maybe people don't pay the rents and he can't cover his mortgage with his full-time job salary, right? Those are going to be the kind of things that I think that will, hit the market first or hardest there. When you're talking about the big boys, and I'm not going to name any names, but when you're talking about your ownership groups who own 1,500, 2,000, 3,000, 10,000 units, they can weather the storm, right? They can weather the storm for a long period. Their risk is spread out over 10,000 units rather than 50 units, right? So I think they'll be able to weather the storm a little bit more than some of the other groups might be able to.
Right, and the way we underwrite these things, we look to have at least some cushion between 20, 25%, sometimes 30 in some markets. So they could absorb a significant amount of vacancy or collection problems before they have a problem paying their mortgage, the bigger multifamily owners. But I agree with Darren, the 1 to 4 and the smaller unit multifamily properties will definitely have a problem.
Yeah.
Right. So this was just something that just came to me. This is why I do this stuff. So Charlie, I'm going to flip this one over to you because I haven't heard from you in a while, and I love talking to you. So one thing that really stood out to me, and I know that we talked about this a little bit at the beginning,
Yep.
the residential market is obviously a chaotic thing right now. People are waiving appraisals, they're waiving inspections, they're doing all the kinds of things to make sure that they get that house. And I know that there's some, chaos going on with the commercial market now too. Has that proved to be difficult for you to structure a transaction right now? Like, do you find that it's difficult to, if you are, putting together transactions, do you find it difficult, getting loans for different properties? Are certain asset classes, are banks a little bit hesitant to, give a loan on an office building or something? So
I think that the lenders that I do work for have definitely been more cautious in this environment. Just before I got on our podcast, I was talking to a client who says, look, credit is drilling me down on every deal that I bring in. It doesn't mean we're completely not doing deals, but credit is really drilling down, and they're really looking at the cash flow.
Right.
And in many cases, they're really looking at sort of guarantor / principal support, right? Mm-hmm. I have closed some large transactions, and they were all sort of closed on a normal standard basis. But those transactions were with established operators who have incredible balance sheet and probably don't really need the money, but they're using the money to be opportunistic, to buy another property or to reposition certain properties. So we're certainly doing deals. I think that the credit folks are being much more cautious about the riskier deals, and they're probably not willing to go out on a limb in a way that they might have been. But I would say that for the established players, what I'm seeing, and again, it's relatively limited in scope, what I'm seeing is business as usual. Right. With the established owners and the established players in the marketplace. And look, that could change, right? If this pandemic carries on longer than people anticipate, that could have sort of ripple effects. But we're talking about let's look at the different asset classes that my lender clients are underwriting, right? Look at multifamily. As Darren said, that AB product, you're still having collection rates at 95, 98%. Most of the workers who are living in AB product are white collar and probably haven't been as impacted as much as your blue collar workers, right?
Yeah. So
that's still remaining strong. Industrial, incredibly strong, right? And there are .com type outfits that are still looking for more space, and even mom and pop widget makers looking for more space. So we have a number of asset classes that are remaining strong, and I think in those areas it's probably been business as usual for the most part.
Right.
Yeah, and I think I can talk to the opposite end of the other assets that Charlie was not talking about. So I like I said, I love to have these conversations all day, every day. And I'm not even going to talk about retail. I'm going to talk about retail and hospitality.
I didn't go into the hotel.
Two bells of the ball right now. The two bells of the ball, right? So I was speaking with a gentleman who's considering starting up a hospitality fund right now, and he has no interest in even looking at debt. It's going to be a purely equity fund, right? Because they know that they can't finance the deal. And it's his first fund, so it's going to be even harder to do that. Again, because he's established ownership group, but first funds still a little bit harder to kind of get financing that way, right? And he has his capital, he has his equity already put together with his people. That's the way to go about doing it if you're gonna do it in the hospitality arena.
Right.
And same thing with the retail end. I spoke with a gentleman actually earlier today, worked for one of the huge retail shops nationally and internationally, and broke off and started doing something on his own this time last year. And, I was talking to him about a transaction that, was supposed to close on March 23rd, of course, right? I've heard 1,001 of these transactions that were supposed to close on March 23rd that never closed, right? And all of a sudden, retailers are out and the bank is now underwriting it differently and the value's down and the owner doesn't want to sell at the lower value, right? So he's like, moving forward, what I have to look at is buying these deals cash, doing the improvements that I need to do, seeing where the market goes on the retail end. He understands retail very well, and he's like, okay, well, I've dealt with a large portfolio, so I know, where to find it, where to kind of approach the value add positioning, and then refining out in the 4 years after we kind of get back to some level of normalcy. Now retail is the most interesting of all of these products to me, because that normalcy is going to be completely different. So those people who have a particular skill set, they have the equity, they have people who are going to trust them in handling this type of asset, they're going to make a lot of money if they know how to reposition it the right way, obviously following the trends that we're going in, with retail and e-commerce and everything else that's kind of involved.
Right.
Yeah, I think Darren makes a good point about hospitality, because I didn't mention that in sort of my optimistic spiel before, but we're actually seeing sort of mezzanine debt foreclosures and some foreclosures like that in the hospitality space on certain portfolios of hotels. And we're not talking about, Motel 6. We're talking about some portfolios of some pretty premium branded hotels, right? They're, and Darren can probably speak to this, and Jeff can probably speak to this better than I can. But, a lot of these hotels are underwritten at, 80% occupancy, right? You assume you're going to have 80% occupancy. Most of them are at 40% right now. So that's definitely a tough segment of the market. But, to Darren's point, right, I think if somebody is opportunistic, somebody has some cash, there's probably an opportunity to scoop up some trophy premium type hospitality properties, and in 5 years' time, look like a genius for having done it.
Right.
Absolutely.
Yep, and I think that's the timeline too, Charlie. I think it's 4 years to actually come back to some level of par, and I think 5 years you might have a chance to sell.
Yeah. No, well, think about it, right? Like, even if you're not overly worried about COVID-19, right? You don't have anyone in your family who has a comorbid situation or is elderly. Do you really want to be in a crowded hotel or resort with other people right now?
No way.
I think even the people who are most cavalier about this whole thing don't really want to be in a crowded space with other people. So it's just a tough segment of the market.
Yeah. All right, so I'm going to move us into our closing segment of our show, Under the Spotlight, where we ask each of our panelists to give us a bold prediction, or at the very least, a prediction moving forward. So, Jess, we haven't heard from you a little bit, so we're going to start with you. So what do you got for us? You're under the spotlight.
Let's see. I don't think the kids are taking pictures with Santa this year.
I would agree with that. Yeah.
I think they're FaceTiming him.
Definitely. Darren, what about you?
Bold predictions. I think that this is a bold prediction. I don't think this is the death of retail, right? So okay. I really don't. I think, again, it's I don't know how bold this is. I think it's the transformation. If you look at some of the statistics on retail, right, we just always have been over retailed in the United States, right? And I think it's just a transition into, like, again, what everybody else is talking about. So I think, if you look at our country and please forgive me if I get these stats wrong. I think we have like 23 and a half square feet per person of retail space nationally, right? If you look at a place like Germany, it's like 2.5, 3 square feet per person. So it's like we have a little bit too much of retail, and I think a lot of that's going to get eaten up by the big box stores that are unfortunately not doing well. But my bold prediction is retail is alive. We just don't know how alive it is.
Life support. All right, Charlie, round us out, man.
So my bold prediction is that New Jersey real estate is going to surge in 2021, and here's why. We got three classes of real estate that are really important to New Jersey: residential, suburban office, and industrial. Residential, you already saw before this crisis, older millennials start to move out of the city because of affordability issues. Now, because of COVID-19 worries, every residential broker I talk to has 5 offers for every house in the suburbs that is on the market. So I think residential real estate is going to do well. Suburban office, to Jess's point from earlier, I think, companies are going to look at establishing outposts here for their employees who live here and don't want to trek in through Penn Station, Grand Central, Times Square. So I think there's going to be, I don't necessarily think office itself is going to surge. I think there's going to be a lot of downward pressure, but I think there's going to be some support there for the New Jersey office market. And then industrial is going to just keep going gangbusters because everyone is going to be utilizing that asset. So I'm optimistic. I also just see a lot of activity. I may not be doing as much finance or lending related work, as I was a month ago, but we have lots of clients who are really interested in buying stuff and maybe they're paying cash. But I just sense that beneath all the noise in the news that, the entrepreneurial class is forging ahead.
Yeah. I think what really happened here is that COVID was kind of like a timeout for everything. And it's gonna snap back at some point. Yeah. I have to agree with you, Charlie.
Right. Yep. Right. All right. So for everybody listening, that wraps up our show. So make sure if you want to listen to a specific topic, if you want to be a guest on the Spotlight, make sure you go to themorningspotlight.com. Email us at themorningspotlight@gmail.com. I'll make sure I put everybody's contact information in the show notes so you can reach out to them if you have specific questions for them. I want to thank our panelists, Darren Griffith, Charlie Wilkes, Jess Veliz. Couldn't have done this without you. You guys did great. Thank you for coming on with us.
Thanks for having us.
Mike.
Thanks, Mike.
Pleasure.
Thanks,
Absolute pleasure.
Absolutely. And everybody else, thanks for listening. We'll catch you next time.